Hello, I'm Steve MacLellan, the financial engineer and very proud member of the IBCanada Group. And we have a great show here today. We have 5 independent financial advisors, include myself, that are going to go over the top 5 myths of what they've come across during their experience in the financial industry. And then we're going to go chat about them and see if we can come up with solutions to these myths. You are going to get a ton of value from this show, and we're going to start right away.
At IBCanada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
You ready to go, guys? Everyone ready? All right, let's start with you, Dave. Now, you are working out of Calgary, Alberta. You've been in the financial industry for how long?
For 38 years.
38 years. Right. And we are all independent here. So what's the biggest myth that you've come across over your 38 years in the financial industry? I'm going to give you 2 minutes to go over what the myth is and why it's a myth.
Thank you. I guess recently I actually shared or did some research to find out, to answer some questions that I've always had. And let me just share my screen and I'll just share this with you here. I guess one of my financial myths that I like to talk about is in regard to, in order to get stock market returns, do I have to take high level risk? Do I have to take stock market risk? Well, in my opinion, that's wrong. Of course, I think we all understand that no advisor anywhere can accurately predict the stock market yet. And let me change, there we go. But yes, it's still funny that consumers expect us to do so. But really, even the top financial experts in the market, they do have losses at times. It's not all gains. But that said, in my 38 years of experience, research proves you can get stock market returns without taking risk here. Appears my screen is going to jump ahead on me. Apologies for that. So I did a study back in 1990 and wanted to compare how well the stock market did compared to another alternative. We'll call them Method A and Method B. Method A is the stock market, the Toronto Stock Exchange. And for those who like roller coaster rides, it's perfect for you. However, my experience is most do not. Most would rather prefer a slow and steady ride, something like Method B. So the question is which of these 2 methods did better since 1990? And to save some time, let me just jump to the answer. The answer is Method B. Believe it or not, Method B produced greater financial returns than did Method A. And again, that might surprise you. Method B also includes some guarantees. So very quickly, just a comparison. Both will provide stock market returns. In fact, Method B has shown it will provide better than stock market returns. Method A does have the high volatility and risk as we showed. Method B, slow and steady. In fact, the risk is 10 times less than A.
Awesome. And to interrupt you, because that's my job here as host.
You're welcome.
Your 2 minutes is up. When you're talking about Method B, what is Method B?
Method B is something called dividend paying life insurance. It's something that our grandparents had used a lot, and something that I guess I know, like me at times, something works and we stop using it. It's something that's been around for so long, and it's just proof that something that has been there before doesn't need to be vacated, if you wish. I think we need to look at it more closely.
I agree. One of the things I've learned through my career is money is very emotional. And what do we end up doing? We end up buying a lot of times when the stock market's high or on the way high, and we sell when we're not supposed to.
Yes.
Right? And that's true with advisors. Anybody agree or disagree with Dave?
I loved what Dave had to say. If you have a 50% loss, you have to make 100% just to get back to even. So these infinite banking policies can never lose money. And that is why they're kind of coming ahead. Plus, exactly what you said, Steve, about human emotion. We just want to buy when it's high. We can't stop ourselves. So I really liked your chart, Dave.
Thank you.
And Scott, I know you're never short for words. Anything to add?
There's actually a behavioral finance concept that our brain is always looking to connect the dots. And that is why when the stock market is going up, we believe that it's always going to perpetually go up. And then conversely, when it goes down and it actually becomes on sale, we believe that it's going to continue to fall. So why would I buy today when it's going to be cheaper tomorrow? Oh, look, it's cheaper tomorrow. Great job, I didn't buy. Let's wait till the next day. Oh, look, it's even lower. And so you get this yin yang where you never really know where you're going. So this whole idea of volatility and risk to equal returns is actually going to get people, as you said, to jump out of the market when they should be taking advantage of it. And if you can get rid of that volatility by having those guarantees and the method B, clients are going to be able to stay in for the long term and really compound their wealth.
Glenn, why do you think so many advisors and the general public are infatuated with the stock market versus, well, we just talked about the infinite banking concept or a properly structured dividend paying whole life policy? Well,
you know, it's kind of how most advisors have been trained. Let's put it that way. Especially if you're talking wealth advisors, that's how they've been trained. This is what you put in front of people. This is how you make money. And that's not to say you can't. Let me say that right off the bat. However, when you look at percentages, and we're very familiar with percentage of return versus actual return, right? Use of money, timing of when you need that use, there's a whole lot of education that's missing out of that. And let's face it, as you guys said before, people try to pile on when things are popular. They may not understand it, but it's going up, everybody's making money, I want a piece of that, right? And if you jump on that roller coaster at the peak of that climb, what happens next? You're going down that hole.
and that's generally what a lot of people do, because it's as Scott mentioned, human nature. And, you know, it's very exciting. And you can do this on a 30-second blip on the news or on the radio. You can't really make dividend paying whole life policies that exciting. Although it can make your life more exciting, it's hard to get, because there's no downs. It just steadily grows. All right, so Dave, to recap, and correct me if I got this one wrong, your biggest myth is you don't have to be involved in risk to capture the rewards.
Exactly, yes.
Awesome. All right, moving on.
Sorry, can I add one thing to that?
Do you know what? I'm going to give you permission to do so. Yes.
Thank you, sir. Thank you. I've been doing this for 28 years. Consistently, the people who seek the highest rate of returns are the ones that have the least amount of capital to invest. They look for the rate of return to make up for their inability to finance their future.
The wealth mindset versus the middle class mindset. Yes.
Exactly.
Okay. I'm looking
forward. And that's why the market is so exciting to them, because they need that rate of return to make up for lost opportunity and lost timing.
And everybody always hears about the big wins. Everyone always talks about the big wins, but nobody's fessing up about the big losses either, though.
Glenn, what do you feel? Okay, well, Glenn, you're based out of sunny Edmonton, if I recall.
Or is it Calgary as well?
Calgary as well. Oh, we got two. Okay, good. This means there doesn't have to be any real scraps on this broadcast. How long have you been in the industry for?
I'm in my 20th year.
And a friendly reminder, everyone is an independent advisor. So they're not representing a firm. They're doing what is best for their clients. What's the biggest myth that you've come across in your 20 years, and why is it a myth? Two myths.
It's the understanding of how RSPs really work. It really is. I've had crazy thoughts. I had one gentleman, not my client, who said he was in his 60s. I remember this, he had 30 grand. And his understanding was, no. When I retire, the government gives me 30 grand every year. No, not how it works. You don't even have 30, because when you go to take that out, it's going to be less, because the government's going to jump in between and say, hey, you forgot your silent partner here, right? But I'm going to leave that part alone and let, I think Kathleen's going to touch on that a little bit. Really, it's such a popular thing because everybody says, hey, get started, start an RSP. I got clients sending me their 16-year-olds who started working and 18-year-olds starting RSP. And I'm going, wait a second. They don't need to do that. And here's why. There are better tools. Why would I try to get a break on something that I'm going to have to pay the piper down the road? And again, Kathleen's going to touch more on that. Right. So yes, it is a tool. It is out there. There's people that have a bunch of money in RSPs. I'm like, look, since you got it there, let's deal with it. But understand, there's also, as Scott likes to talk about, the lucky lottery of when you were born, right? Because if you retire and things are in a down slump on the markets and you need to withdraw money, boy, not only do you're taking out a money that's lower that you'll never get back or get a chance to make more on, but Kathleen's going to tell you how much worse it is when Ottawa jumps in the middle of that, right? So that is that's a topic that I talk to people about. There's so many myths around it and how it works and why it's the best thing. And I'm like, no, it's a tool, but it's not necessarily the best tool for you.
So RRSP is not the best tool. It's probably better than doing nothing, but that's about it. There's a lot of better tools out there. And mainly because you said the silent partner tax is where you're taxed down the road. Now, who on this call thinks taxes are going to decrease in the future, or who thinks they're going to increase?
Not in my lifetime.
Right. Yeah. Especially with what's going on. And so you were talking about RSPs, Glenn. It sounds like you have is it RSP, or you can tell the future? Because I have no idea what Kathleen's going to be talking about. So I'm excited to hear what Kathleen has to say. But before we bring her on, who would like to comment on what Glenn had to say?
I agree. It's one of the most important financial myths that are out there. I think that the whole point of RSPs is to be in a lower tax bracket when you take the money out. But so often clients will run into trouble and take it out actually during their working years, and then they pay so much more tax. And then it ends up being really the wrong strategy. And just to build on what Glenn said about young people, they're typically in the lowest marginal tax rate of their working years. So save your RSPs for when you're in a high tax bracket. RSPs are great tax tools. They're just not great wealth creation tools.
Yeah, it's not necessarily what you have, it's what you get to keep that's more important.
Yeah.
Right?
And I find it so bizarre. Like when you apply for a mortgage, if you have 100,000 in your RSP, they mark 100,000 down as an asset you have. But Glenn is right. You haven't included your silent partner, the government. You don't have 100,000. You might have 50,000 if you had to take it out.
Exactly. If I like using the $1 million, the $1 million. If you seen a big investment and you need it, and that $1 million is in your RSP, you're not getting that $1 million. The government's going to ask for, well, in Nova Scotia, almost 51% of it. So 500,000 goes to the government. The silent partner that Glenn mentioned, you get to keep 500. There's got to be better systems out there than that.
I mean, yeah, like I said, just to add to that, actually, you know what, we'll let that go for now. Kathleen's got some interesting stuff, I'm sure. So we'll chat a little bit more after.
Okay. And the dividend paying whole life policy, when it's set up properly, gives you access to 100% of what's in there.
It's about 90%. Normally, I think there is a firm that will offer 95%.
Yeah, there's 3 ways to get access. You can take it directly out where you will be taxed on your capital gains. The second way is a policy loan using the insurance company, which is roughly 90% of the cash value. Mm-hmm. No questions asked. It's a sign of the paper, easy peasy. And then there are institution banks and other lenders where you can gain 100% access through a bank loan. There's as my aunt used to say, there's more than one way to peel a potato, right?
There you go.
These infinite banking policies are way better strategies than RSPs because it gives you liquidity use and control without being tax punitive.
Right. And Steve, just to mention, I think you referenced capital gain. Any gains from a life insurance policy, I believe, are treated as income. So just wanted to make that clarification.
The ACB, listen, okay, good clarification. Kathleen, Van Captain Berg. Where are you at today, and how long have you been in the financial industry for?
I have been in the industry probably about 30 years. So hopefully nobody's calculating my age, because you just shouldn't do that with women.
And giving you 2 minutes, what's the biggest financial myth you've come across through your 30-year career? And why is it a myth?
The biggest financial myth for me is that people will be in a lower tax bracket in retirement. It's really building on what Glenn mentioned about RSPs and how RSPs are the wrong strategy if you will actually be in a higher tax bracket. I mean, it's one of the biggest lies out there. And for a couple of reasons. First of all, I hate it. I absolutely hate it that financial planners want you to be poorer, right? Putting you in a lower tax bracket means they're saying that you're going to be poorer than you are now. And I don't want that for my clients. I actually want them to be in a higher tax bracket because I want them to be wealthy, uber wealthy. But with these infinite banking policies, we're able to do that in a much more tax efficient way. Second thing is, I, for one, and you mentioned this earlier, I think that we as Canadians are going to be in trouble from a tax perspective. There's no way that I see the government lowering tax rates in the future. So I don't want to have this big tax bomb in a registered asset that I'll actually be in a higher tax bracket and it will have been the wrong strategy. I think governments will be in trouble and they will have to increase tax rates. They will have to cut back on things like OAS, even CPP. They can extend the age at which you're going to be able to qualify it for. They move all of the levers. So we need to have solutions that are tax advantaged. And the third thing is tax bracket creep. So if my pay is just going up by the rate of inflation, right, I will be making more money from a dollar perspective. And as a result, I will be taxed more and may even jump up tax brackets. But the purchasing power of my money has remained the same. So that alone is going to put people in a higher tax bracket. So I just believe that people they will not be in a lower tax bracket in retirement, that they will be in a higher tax bracket because of tax bracket creep, because the governments will be in problem. And want to raise rates, and then they're going to cut back on benefits.
Each of these myths are really strong. So the myth that you've come across, that, and I can tell by the way your body even changes, that you have a passion for this, that people, the fact that the people are going to pay less, be in a lower tax bracket in retirement, is pretty much hogwash.
It's a lie.
Any comments on that?
Yeah, definitely. Kathleen, I love that you touched on inflation, and all we got to look at is the last 10 years. I've heard people say, oh, I'll just rent. Well, okay, fair enough. You could do that. How's a loaf of bread 10 years ago compared to now? Or buying a steak, right? Just the buying power to maintain where you are, or even if you plan on living 20% below your means, 20% below your means in 20 years is probably 20% above the dollars you need right now, right? So you're not going to be in a lower tax bracket. You're going to be in a lower.
Inflation is that hidden tax too. Yeah. A lot of people will say that. So I like that you're mentioning that.
Exactly, right? So when you look at stuff like that and you compound that, as you touched on, if I had $1 million in RSP, I don't really have $1 million. I got maybe $500,000. And then when you take that out, it's taxable. It might bump you up to the next bracket, so you have even less dollars to spend. I love that we look at the overall dollars that we can give our clients on a consistent basis in their pocket. Forget what shows up on paper.
But what if you're bumped up to the next tax bracket, OAS is clawed back, or your spouse dies and their registered money rolls into you and you're in a higher tax bracket again? There's just too many things to go wrong.
Taxes are one of the biggest, villains for you to reach your financial independence goals. It's taxes are going to be your biggest expense. And there are ways, and it is, as a Canadian, it is your right to figure out ways to pay as less tax as possible. Go ahead, Scott.
So this whole idea of being in a lower tax bracket stems from the pre-1970s period, or the pre-1980s period, when the predominant retirement plan for Canadians were defined benefit pension plans, which guaranteed you 60% of your income, which would be, you would be in a lower tax bracket because you're forfeiting 40% of your income once you get to retirement. Why are we still transferring that mentality into the future now? It makes no sense whatsoever. And to go with what Kathleen was talking about, the government, any political party can stand on a platform of not raising taxes, but all they will do is raise the marginal tax brackets. So now somebody making 100 grand a year that might be in a 35% marginal tax bracket suddenly can now be in a 40% marginal tax bracket. They didn't raise rates. They just readjusted you into a higher bracket to get more money. So now if you have a limited pool of money because you were planning on retiring with less income, that less income is now going to be higher taxed. And that is a double whammy for Canadians.
This is not your grandparents' economy, and it shouldn't be your grandparents' type of plan.
Exactly. Exactly.
No, I've been
Kathleen, you
lucky.
were-
I'm kind of like Hank Snow. I've been everywheres. And when I moved back up to Canada, I remember receiving my first paycheck in Alberta and just being shocked with the amount that came off. And then when I moved to the East Coast, it was borderline crippling. And I do believe it's one of the reasons the struggle is real. So it's one of my passions, and it's one of the reasons why I'm so happy to be part of this group, is to help people reduce their taxes. Listen, if there wasn't mismanagement of all the funds, I'd have no problem paying high taxes. But the truth is, I'd much rather given the ability to the person to have their money and control it. And it's my belief, if you have control of your money, you're just going to make your communities even better versus the waste that goes on.
Right.
Dave, go ahead. I interrupted.
No, that's fine. I was just going to add to Kathleen's comment. I think the one thing she was trying to share a little bit is about control, and really it's just a reminder of the RSPs how little control that we have over some of our financial assets. So I just wanted to share that.
Thank you.
One thing to add, part of infinite banking and what we do is to let Canadians know about problems they're not even aware of. So really the big question is, if you're aware of you growing a harvest that is going to be increasing tax liability and you become aware of it, would you not want to find the solution to how you can avoid it? And that's what we specialize in.
100%. So we covered, you don't have to be involved in risk to get the rewards. We talked about RSPs and the way that they work and the way that they don't work. We talked about the idea of being taxed at a lower tax bracket down the road or in retirement. Pretty much hogwash. It's a big lie. Scott Cordier, coming from Upper Canada. How long have you been in the financial industry for, and what is the biggest myth that you've come across? It can be one that's discussed already. And why is it a myth? I'm going to give you 2 minutes.
So this is my 28th year. And the biggest myth is essentially everything that has to do with the conventional wisdom of our current financial planning model, which is an experiment because it only came into fruition in the late 70s to early 80s. And the guinea pigs are the baby boomers. And when you take a look at the state of the economy in Canada, where we have incredibly high debt, our debt to income is 186%, a record high. We look at how little people have saved for their future. And this is the experiment that we're now realizing that it's not working properly. So I always like to talk to people about the ideology of you have 100% of your after-tax income coming in your front door. And we are told that if we are really good and lucky, we should save 10% of that and let the other 90% go out the back door. And I give people the example of, if I give you a 10-legged stool, and I said, that is a stool that you're going to stand on to support your retirement, how stable would you feel? Everybody goes, incredibly stable. I said, but traditional financial planning has me take away 9 of those legs, leaving you with just 10% of them. How stable do you think your future is going to be trying to balance your retirement on one leg?
Mm-hmm.
And when you understand how simple that concept is, you ask yourself, why are we doing the things that we're doing right now? And it's because everybody wants access to all of that money that we're transferring away. And the 10% that we do keep, everybody else makes money off of it before we do.
Right. So this is a big one. You're saying pretty much the current financial planning in today's financial industry is really focusing on the wrong things.
Yes. And I can say that with 100% certainty because of my 28 years. I'm a certified financial planner, chartered life underwriter. The more I started searching for the solution, the more I found the problems.
This is a big one. We've got a fantastic group here. Who would like to make the first comment on this? Because to me, this is a big deal. This should be an eye opener.
This is the reason why I went into infinite banking with an insurance focused. I'm ashamed to say my corporate life before I was became a certified financial planner in 2002, I think, was in the mutual fund industry. And I saw firsthand that it was not getting Canadians where they needed to go at all. It was not creating a retirement for them at all.
Yeah, no, very good. I think my story is very similar. When I started off, I was rather young and perhaps a little naive, but over time I have learned that I think expecting 10% from the stock market every year clearly has not happened. And when you start analyzing the actual results in the environment like Scott has, I think we all have come to the same conclusion. Again, that's why I'm involved with infinite banking. It's just become very obvious that this was the best way to, and still is, and is for a lot, for many people, the best way to grow your wealth.
Glenn, anything to add on that?
Definitely. I mean, I love what we do for people. Okay, let's talk about what you get to control. Because as we talk about RSPs, you don't control, you can sit there in your 72 and say, I'm not taking anything out, but you don't get to make that choice. The institutions will send you your RIF minimum, right? What tax bracket that puts you in, especially if there's bracket creep, that's life because you don't have that deduction again. Let's say you've got all your money piled in your RSP, there's a wonderful opportunity. How can you access that? Well, you can, but you're going to pay dearly to get to that money. What we do for people with infinite banking is we say, we're going to take the guessing games out of it. We're going to tell you that you're going to have a steady climb. You're going to have access to those resources and not by losing 50% of it either, right? And you're going to get to structure things that's going to be the most tax efficient way for you in retirement, right? So each dollar you get, if done right, will be $1 in your pocket as opposed to my dollar minus my silent partner is 50 cents. Ah, geez. So yeah, I'm pretty passionate about our group and what we do for Canadians and how we're helping them to just have more control, more steady growth, and protect what they've got.
Steve, I want to go back to the RSP for a second. I can't tell you how many times when I ask somebody, so why did the government create an RSP? And the answer is so that we don't become a burden to the government. Interesting. So if the government really wants us to be taken care of, then why do they require us to take an income? Why don't they give us the flexibility of deciding if we want an income or we don't? Why is it that they mandate that every year that income has to be higher? It's not because they're taking care of us. They created this so they can take care of them. And that's something that people have to realize. The RSP was not designed for our benefit. It was designed as a tax benefit to the government.
No, yeah. The way it was brought to my attention was, CPP was a great deal for the government. They're like, hey, listen, we're going to get Canadians to pay into this to the age of 65. And the average lifespan at this time was 67. So we only have to pay for 2 years. It's going to be awesome. And then what happened to our lifespans? They increased. The government's like, holy crap, we're not going to have enough money. Let's do what the United States is doing instead of the 401k. We'll call it an RRSP, and it's going to be gravy. We won't have to hand out as much. But I digress. These are big myths. All right, and I couldn't agree with you more. I like Kathleen. I got into the financial industry because I thought I was pretty good with money. I loved the stock market. I loved investing. Got in, got my securities, got my mutual fund license, and realized there's very few people that are in the stock market Hall of Fame, right? That up and down ride. It's tough for our clients. It's tough for the advisors as well. I wanted to sleep at night and have access where my clients are sleeping at night. And that's one of the reasons why I love the infinite banking concept so much. We talked about so much today. Do you guys want to hear what my biggest myths? You guys really knocked it out of the park and talked about the myths that I've come across and how much my financial planning has changed because of these. We talked about the risk, not having to have the risk to get the reward, which is foolishness, right? We also talked about RRSPs, why they're not the best tool. Yeah, far from it. And taxes. I think we talked about the word taxes. If there was a count for it, probably came up 20 to 30 times. And then the current financial planning, the system is broken. Very powerful stuff. Do you guys want to hear what I think is another myth? No one wants to hear.
Go for it.
I'm dying here.
We kind of talked about it a little bit, but one of the things that we didn't chat about is that debt. There is some very bad debt out there. There's the consumer debt, the debt that doesn't increase your net worth, but there is such thing as, I like to call it, not bad debt. All right. Hopefully you get rid of it all through different ways, but having debt that can actually help you grow your assets can be very powerful. Having other people's money to make you money is a great way to build security down the road. And that's one of the things we do here as well with the infinite banking concept. We show people how to become their own banker instead of relying on the banks or amassing that consumer debt that is very dangerous out there. What do you guys think of that?
There's a great quote that says, the vast majority of the wealth is held by the few. And since that is correct, why are we managing our money like the majority? Once you understand how the wealthy consistently grow their capital, it's not subjecting it to risk, it's taking advantage of risk after it's happened. Stock market falls, they've got the capital to go take advantage of it. Real estate goes on sale, they have the ability to take advantage of it. But at the same time, they are consistently using other people's money to allow their capital to consistently grow in a tax sheltered manner. And that's why every financial calamity that's occurred, the wealthy come out with more money than they had going in. Yeah. The rest of us lose money.
And it's happening right now as we speak. The transition is happening.
The wealthy use good debt. I always say that debt reduction is not the path to wealth creation. Financial planners, mortgage brokers are always saying, pay down your debt, pay down your mortgage. But instead of putting that extra $1,000, $2,000, $10,000 a year down, if that money was used for wealth strategies, you would be further ahead because you only need to beat the mortgage rate, right? If your mortgage is 3%, why are you rushing around to pay off 3% debt when you can do better than 3% with your money in an income property, in a boring dividend stock like a Canadian bank or Enbridge, in your business that you might run? If you can beat the mortgage rate or you can borrow to invest in a wealth strategy, you will come further ahead.
Yeah. Scott, the other day shared a great example of that conversation, perhaps for another video, but exactly why are you investing or why are you not investing, I guess, outside of your mortgage? Because you're right, Kathleen, if your mortgage rate is 2 or 3%, there certainly are better opportunities out there.
Yeah. And I love these infinite banking policies because you can collateralize them and borrow against them. Yeah. When I put money in my TFSA, sure, it grows tax sheltered, but I can't borrow against the TFSA. I can't borrow against my RSP. So it comes back again to liquidity, use, and control of my money, creating my banking system.
Yeah, exactly. Working capital is how I like to describe it.
Yeah. All right, so we showed you 4, if you include mine, 5 myths that are completely busted. We also provided solutions on how to rectify these myths and to make sure that you are creating wealth and becoming your own bank. And that's what we do here at IBCanada Group. We are independent advisors from coast to coast to coast that will help you grow, control, and protect what you build instead of giving away to taxes, fees, loss, or the unknown. As we wrap up here, team, I'll give you each 1 minute just to sum everything up and finalize, starting with you, Glenn.
Okay. Well, I think the running theme is you're going to have more control. You're going to be able to grow predictably, right? And protect what you grow. And by doing that, especially with the properly set up through your authorized practitioner, I'm going to say it, policies, then you have all that control and the tax man gets as little as possible. So you get to keep more of what you grow and you have access to use it for multiple strategies, like Kathleen mentioned, taking advantage of real estate. If you want to go buy the stock market, it's a great time to be a contrarian, like most of the wealthy. When we have a downtime, you go pick things up, you win on the buy, right? So I love that what we do gives people so many options and gives them control and gives them just more net dollars in pocket. And I'll leave it there.
Well said. Kathleen, your final words?
I just want everybody that's watching this video to go to the IBCanadagroup.ca website, find an independent infinite banking practitioner, and let them show you how you can create liquidity, use, and control, protect and grow your money, avoid taxation. They will show you how this is a better strategy than the RSP. They will show you how you can take control of your financial situation and not be in that traditional financial planning model that is not helping Canadians.
Awesome. Well said. Dave?
Yeah, I guess I would summarize what infinite banking provides the opportunity to do is it allows people to grow better wealth with guarantees, the ability to also accumulate that wealth, which much lower risk than what they need to. And they would also be very pleasantly surprised at the ultra low fees it also delivers.
Excellent. And one of the founders of the IBCanada Group, Scott, final words.
Final words. Oh. Infinite banking, becoming your own banker. A great quote from the author Nelson Nash stated that if you're not aware of a problem, you're never going to search for the solution. If we think that the current financial planning model is working, then everybody's going to continue going along with it. We're telling you right now that you're not aware of the problems, and I'm hoping that this video has explored at least 5 myths that's going to allow you to start questioning whether or not there is a better way to do your financial planning and creating a future that's going to be as much in control as possible. So grab a book, contact us, do some research on infinite banking, and you'll be completely surprised at what you didn't know.
Powerful stuff. You know, knowledge is only potential power. It's putting what you know into action. That's the real key to success. And if you go to IBCanada Group, you're going to find these fantastic individuals and other financial independent professionals that are going to show you how to grow, control, and protect what you build instead of giving it away. As we mentioned, to taxes, fees, losses, the unknown. So you can reach financial independence and keep more of all that stuff you worked so hard for. I appreciate all of you, and I look forward to chatting with you again. And now that a lot of restrictions are leaving, hopefully we can get together in person in the near future. Thank you so much.
IBCanada Group, your independent authority for information on the infinite banking concept.